Welcome to another accounting video in which we're going to talk about the aging of receivables method of accounting for the allowance for doubtful account at the end of the period. This is another valuation method for receivables. Let's take a look at a quick exercise and see how we would use this information to do our journal entry and decide on the number that goes into the balance sheet. So here we have a company that has accounts receivable of 94,400 at March 31st, 2022. The terms are 210 net 30. At March 31st, 2022, there's a $2,100 credit balance in the allowance for doubtful account prior to any adjustments. They are using the percentage of receivables basis of estimating uncollectible accounts. So let's see what that means. March 31st, 2022, they've given us 21 information. Let's hold off on that as the 22 information. The $95,400 in receivables, they have aged the receivables. What that means is they've looked at how old the receivables are. So in the first category, it's current. It means they have the terms 210 net 30. It's not yet past the 30-day mark, which means all of these customers most likely are going to pay. Hopefully, we hope they all will pay. We have $65,000. This is where you should have your largest amount. In fact, an overwhelming amount of your receivable should be over there. So in this case, they have about 2/3 of their receivable in the current balance, which is good. Anything that's 1 to 30 days old has been put in the second category. It's 12,900. This may not be too worrisome. It could be checks in the mail. Maybe a customer forgot to mail the check. They send it, you send them another notice and they're going to send you the payment. It's not too much to be concerned about, but you need to follow up with them. 31 to 90 days old is that you've gone way past that 30-day mark. You gave them 30-day credit. After that, another 30 days have gone by and these receivables are $10,100. And the last is anything that's over 90 days. It's past 3 months. So really it's 4 months from the time you made the sale. 30 days plus 90, you're looking at 4 months past the date of sale. So we estimate that of the ones that are current, 2% are likely to go bad. The second category, we say 5, your risk is higher. You go to the third category and they say 30% are likely not to pay me. And in the last one, if it's over 90 days, 50% of them are not likely to pay me. So what we're saying is not all the receivables on that due date are the same in terms of risk. So we have, based on past experience, come up with this risk factor. So let's see how I'm going to do this calculations now in terms of finding out what I need to put in the journal entry. So before I start with my calculations, I have my allowance for doubtful account that has a credit balance of 2,100. That's from the information presented over here. I'm going to do my journal entry, and this is going to be on March 31st, 2022. So let me first write down these dollar amounts that I have over here. The dollar amounts I have the total of 95,400. This is the breakdown that's given to me. The next thing I do is I write down what these percentages are. They're 2, 5, 30, and 50%. And the next step is I do the extension, which simply means 65,000 multiplied by 2%. I will do that for each of the 3 ages of receivable. And then I add up all the numbers. And now what I'm saying is this is the amount, the desired ending balance. This is the amount I think is not going to be collected. So that's a number I'm going to place over here in my T account. That's a desired ending balance. If this is the desired ending balance and I already have 2,100 in my account, my journal entry should be only for this number. It should be for 6575. So my journal entry is bad debt expense debit, allowance for doubtful account credit, and that number is 6575, and that's the number I took from over here. Once again, as we've seen in the previous exercise, when we're using the allowance method and the percentage of receivables method we are looking at, we know what the desired ending balance is. If I already have a balance, this number should be for the adjusting number. So the journal entry will be based on what I want the number to be in my balance sheet. So unlike normal cases where you do your journal entry first and then your T account, Here you're putting the number in a T account, and from there you're taking it backwards into your journal entry. Now, we've done the estimation of uncollectible amounts. We've done the journal entry. They've asked us to discuss the implications of the changes in the aging schedule from 2021 to 2022. So basically, I want to do the same type of calculation for the previous year and see what our numbers are. Now, needless to say, you can see over here how alarming it is. Now, my receivables have gone up from last year to this year. That would be good if overall my sales have gone up. So if my sales have gone up, some of my receivables are going to go up too, that's fine. But look at the receivables that I'm talking about that are going to be uncollectible. This is basically the risk I'm assessing. Last year it was 3170. This year is 8675. That number is pretty staggering. So what I really need to look at is in each of these categories, what is happening. While the number has gone up, the number in the current category actually has decreased. All the other numbers have increased. Look at the last category. Last year I had 1100, that was 90 days past due. Now I have 7400, that's past due. This is extremely alarming in terms of how long it's taking my customers to pay. My terms are, again, look at the relevant information. My terms are net 30, 210 net 30. I've given them 30 days to make a payment. If they're taking anywhere more than 30, past the current, it's bad. But if you're going into 31 days and more, that is extremely bad. It means your clients are not paying you. They're just not making the payment. And you need to reassess what the problem is. Is it that the economy as a whole is bad? Is it your clients are having trouble? Or are you being very generous in approving credit when you should not be approving credit to certain customers? That is always a risk you run. When you're very aggressive with trying to move the sales, this happens when the marketing department tries to push more and more people to buy your products or services, and the credit terms are generous. People may be accepting that credit in doing business with you, but then they're not able to make the payment. Sales are good, but if they don't pay you, that's not a good situation. So once again, remember, everything we do in accounting is used for decision making, and this is something that the marketing department and the finance department need to do some soul searching in terms of why are these numbers moving the way they are? Clearly, they are not a good sign. So with that, we end this topic and we will move on to credit card sales in the next video.